and welcome folks to a very special session today, Who's Who of Finance with Almus Risk Consulting. This is Shikhar Garg, your host, and I'll take you through a very interesting session today. Now, there tends to exist a lot of content on the internet over the multiple platforms with multiple talk shows talking about different things in the market, but we are looking to bring you directly from the horse's mouth. And today we have an expert who's been dealing into the financial markets day in, day out for the past 18 years. We are talking about Mr. Arvind Chari, CIO of Quantum Advisors, who not only have been the advisor for domestic investors, but is also an advisor for the global investors. Now, that's the kind of expert that we are talking about with decades of experience on his shoulders. He began his career gaining experience in the macro, credit, and the fixed income portfolio management, but over the period has helped set up one of the first NAV daily liquidity India bond fund for European investors. He's also helped in launch of gold ETFs, equity fund of fund, and multi-asset fund at Quantum. Now, there's a lot of achievements under his belt that we can continue to go ahead about. But today, we would like to hear something very insightful for this brilliant person that we have brought on. Sir, before we go ahead, I just give you an update of this session. This is not just a regular session that we have at Almus where we bring you the updates. It's a bit different, and we've thought of bringing in the expert in you. Now, the session, I am very well aware, as you are so good on insights, that it will be quite good, raw, and insightful. But folks, you definitely have to check this out because it's going to be interesting. So I'll welcome Arvind sir. Welcome. Glad to have you here. How have you been doing?
Shikhar, thank you so much. I've always followed and looked up to what Almus has been up to, and I think you guys have had a great stellar record in corporate treasury and FX and risk, and so lots to look forward to. Very happy to be here and talk to your clients.
Oh, wonderful. Thank you so much. It's good to hear good things from the stalwarts already. So now as we begin, I just want to point you out that as humans, we have a very morbid attraction towards complexity. We as humans love having complex things in our life, even though we want simplicity. So there's one just small request, because as market participants, we tend to get a lot into jargons, which is a bit of a heavy dose for a lot of listeners. So we'll try to keep the jargons at bay and make things simpler for the ones who are listening to us.
Sure.
Fine?
Sure.
Wonderful. So, sir, as we are going through the markets, we've been listening. A market moves in phases. They look at things quite selectively at any given point of time. Right now, they are talking about a lot on inflation and the yields. Yeah. Probably before that, they were talking about the stimulus packages because of the COVID contraction and everything. So now, the recent fad in the financial markets is about talking the real yields. Now, real yields for you people is yields which are adjusted for inflation from the nominal yields that the bonds give. So, sir, what do you think? How influential is this whole real yield conversation, and why has it become so important into discussions right now?
Shikhar, every theme and every issue is a matter of context, right? So if I look back over the decade, so in 2011, right, once the US was downgraded, so US credit rating was downgraded from AAA below in August 2011, and then the entire context at that period of time was about debt and deficits. So countries which run high debt, including sovereign debt, were under trouble. So you would have heard about the European sovereign debt crisis. Some of your young listeners would not even be aware, but they were threats, or there were worries that Italy, Greece, Spain, Portugal will kind of default on their sovereign government bond debt. So, so then that the biggest worry at that time was which countries have high debt, which countries are high deficit, which countries are high inflation. And India at that time was in a very tough situation. Like you people would have heard about taper tantrum, which is basically the US Fed, Ben Bernanke talking about increasing interest rates and reducing liquidity. And countries which were running high debt or high inflation and high current account deficit, high fiscal deficit, were under threat. And so India was, at that time was part of what we call Fragile Five. Morgan Stanley named it, that India will find it difficult to meet its current account deficit and attract capital flows. And we had a big depreciation in the Indian rupee, almost I think 20-25% in a span of 5 to 6 weeks. So that context was about debt and deficits. So India then had to move to what we call inflation targeting. And so what you asked about, keep real rates positive. So India not only moved to target inflation, but also kept real rates, which is, as you said, nominal rates minus inflation in a positive territory, to ensure that real yields are positive, which would attract foreign investors. And they did come. 2014, 15, 16, 17, you got a lot of debt inflows into Indian government bonds and corporate bond markets. And the central bank also bought up FX reserves from that threat of, wanting to finance the deficit. But the world moved on. The world was not as bothered about debt and deficits come 2016, 17, and they moved on to seeking growth, seeking stability, quality, until COVID struck, right? So now inflation is back into fore, right? People are now worried about inflation, because in the prior period, about 7-8 years, there was hardly any inflation. Commodity prices were all actually going down. So your negative inflation, most of the producer price indices or wholesale price inflation in India were actually negative territory for a fairly long period of time. So inflation was not even a problem. But today inflation is a problem, and where inflation is higher than what people anticipated. And that's why this demand for, okay, if I'm getting a fixed deposit at 6% and inflation is 7%, so my real interest is negative. I want more. And, and so it is in the bond market, and so is into the debt market. And central banks will have to focus on that, because it is no longer a monetary problem. It has become a people's problem. It's become a politician's problem. So politicians will ensure that, if they have to be in power, they have to ensure that inflation is under control, and they will force central bankers to hike interest. That's the context that we are seeing. And so my sense is, because of this need that inflation is high, I need to be compensated for the inflation, so I need positive real yields. You should expect as investors that nominal yields will actually move much above real GDP growth. So if you look at Indian real GDP growth, on an average, it tends to be 6.5%, very long term. It fell to about 3.5-4% before COVID, and it's just about recurring. Maybe it's, if I average it, it will be, we are somewhere in the 5.5-6% range. But interest rates might actually will have to be higher. The nominal rates will have to be higher than real GDP growth, which is not the case in developed markets. In developed markets, we've seen negative rates, right? So GDP growth has been slightly positive, but rates have been negative. I think that is going to change. So as investors, you'll have to prepare for this changing perception that what was neutral rate, and we'll come to that question later. What was neutral rate in the last decade might not be the neutral rate today. You should anticipate and expect slightly higher interest rates, because the context of the times, the demand for inflation, the worries on inflation, the demand from the politicians and central bankers have changed, and we should prepare for that. Emerging markets like India will have to again focus on the fact that they will also have to give positive real yields to attract flows. For a country like India, we should always focus on this. I mean, this should never be an issue at any point of time, in any context. India should be able to manage inflation, keep real rates slightly positive, not very high, build and maintain FX reserves, because that's your stability against, or a bulwark against external vulnerability, and try and get the real GDP growth in the 6.5% and nominal GDP in the 11, 12, 13%. If India is able to do that, any major activity long term should not matter. Short term, you'll always have high oil prices, low oil prices. But if these four are into place, manage inflation, slightly positive real yields, good FX reserve, and enough reforms and growth support and fiscal spending to be able to sustain double-digit nominal GDP growth. If we do that, we should be fine.
Okay, so wonderful. I'd like to highlight a couple of points, and I'll begin with the fact that there were worries about the sovereign debts being default out. That's pretty huge. And listeners, it's something which is rarely seen in the financial markets, and that's why there's a whole discussion on how to manage the real yields. And talking about the yields being negative, I think recently we've seen the yields dropping from somewhere around 17 to 18 trillion dollars in negative rates to
Yes.
around 9 or 8 trillion dollars in the overall quantum. So that's the kind of reduction in the negative interest rates that we are seeing.
Yes.
And if we have to talk on the domestic perspective, so you mentioned it quite very well, that we have a very good reserve setup done by the central bank, and we are seeing fairly bit amount of reforms coming in. So just talking about the domestic perspective, I'll get back to the pointer that you mentioned, that they have to maintain rates above the GDP. And one of the tools that the central banks use is by hiking rates. And almost all of the central banks major central banks are hawkish, except for Japanese central bank and the recent struggling central bank of China. So what do you see? What is the neutral rate expectations for these central banks, as they've been talking about reaching to a neutral rate? And also, what is our central bank, RBI's stance on all these activities and the rate hikes that they are talking about?
So, as I mentioned in my first reply, that when inflation goes up, it becomes a political, social context, right? Or I won't say problem issue, but it's the context changes. Even in the US, it is conservative from that perspective. US might be capitalist and very open and market economy, but from a politics perspective, it remains conservative. So fighting inflation will be the biggest challenge. The politicians will ensure that the central banks will fight inflation. And when you talk about neutral rates, again, perspective matters, right? Not long ago, maybe in about 2007, the US Fed fund rates was above 4%, right? It's only the last decade where growth slumped so much that rates were zero. And as you said, negative yielding, right? Much of that because of Europe central bank was in negative nominal repo rates and bond yields for a fairly long period of time. And there's a lack of growth. And that's why we are still figuring out, okay, rates are going to go up, but it's still from a historical perspective, we've seen this before, right? If you think about, again, neutral rates in terms of what is the reality, the growth reality may be different. I mean, no economy is kind of growing at the rate at it which was growing in the 90s and 2000s. Of course, growth levels are lower. But in terms of creating infrastructure, creating capacity, we might see that, slightly normal rates, slightly higher neutral rates will not be as bad for the economy as people kind of make it right now. The world should be able to absorb slightly higher interest rate. Now, if you look at in the US itself, and I'll come to India, if in the US, the debt, which is the problem when interest rates go up, right? Because you're repricing, your cost of interest on your existing debt goes up. In the debt in the US is mostly in the government sector. Households are not that leveraged. Corporates are not that leveraged. So the ability of a government or sovereign government to withstand high rates by just reissuing and refinancing its own debt is reasonably high, right? Yeah. Even the corporate sector, unless you're funding very high levels of infra projects by taking on debt, you're not as sensitive to interest rates as a normal corporate who is doing capacity creation. So ability to withstand rates is slightly higher globally. And the tools, as you said, are very similar, right? Rate hikes, liquidity removal, and selective credit controls on your risk weights. And so mostly rates and liquidity. So India also has no option but to follow. India might choose a rate path and a trajectory which might be lower. So our sense is, and I still believe that, is that the RBI under DAS will try and keep the repo rate, which is generally been 6.5. That's your average, right? 20-year average will be about 6.5%. They'll try and keep it below that level, given the demand scenario that we have, given the economic scenario that we have. So our neutral rate will be tried to be, they'll keep it at say 5.5%. But if inflation remains a problem, demand or supply side, they will have no option but to follow what the global central banks are doing. So you will see rate hikes and liquidity tightening in India, but the pace and the trajectory of it might be very different than what the US is facing right now.
So that actually is the question. I mean, the growth reality is quite different for a lot of people, and also with respect to the nations, because the whole idea of their economies and the operations of those economies are quite different. And recently we've been hearing expectations of 250 basis point hikes in just 1 year, and then further another 200-300 basis point hikes for the US central bank. These are quite significant, and anecdotally, if we see, they've never been able to reach to the kind of expectations with respect to rate hike that they've been having. And that's why the whole question of neutral rates being coming into consideration, because the market may expect any kind of rate hikes, but the economy should also be able to sustain these kind of rate hikes. So that was very well pointed, and it's good to get some bit on the range expectations of the repo rate by RBI. Now it's a bit on the far side for us, considering we have not acted much by the central bank, but it's definitely in agreement, wherein we also see RBI having some bit of a lower trajectory, but they have to follow through with the other central banks. So how do you think this shift in stance or this shift in rate hikes will change the borrowing cost? What do you expect? Because the expectations of these shift in rate hikes have already influenced the kind of spreads we are seeing with respect to borrowing, and it's been quite significant. The kind of charts that we're seeing is exponentially high for the spread. So how does this impact corporates as a whole as well?
I don't think the corporate spreads are exponentially high. Maybe in certain segments of the bond market, globally or India, you might see some liquidity related issues. And that's why, because the rise in the treasury yields have been so significant, you might see some dislocation. But the growth environment is still reasonably upbeat, right? Especially in the US. Of course, the recent GDP number was not that attractive, but on the background, US is in a economic upcycle, or was in an economic cycle. Now when financial conditions tighten, it might kind of slow down. That tends to be a good period for credit spread. When GDP growth is better or improving or rising, credit spread should do well, because corporate profitability, corporate acceptability, confidence in corporates is much better. Also, if you look at borrowing costs as unless, as I said, unless you're funding something in infra and project, which is say government or PSU or large corporate fund, which is like 80% debt, 10-20% equity. In those projects, interest cost will matter. So if the interest rates goes up by 100 basis points, there's a significant impact on the profitability and the cash flows of the project. But if I look at a normal corporate capex, right, interest cost as the percentage of the corporate capex is never really that high. So a 100 basis point increase in rates should not materially change a decision of a corporate to build capacities. If they see demand and if they see pricing power, they will go ahead and build capacity irrespective of the interest rate. And we have seen that historically in India. We've seen capacities being built in India at 14% interest rates, and capacities being built in India at 7% interest rates. It's a function of demand and demand supply in the economy and their pricing power. Also, corporate capex also is a function of corporate balance sheet strength. And we've seen, especially in India, corporate balance sheet strength has been very, very good. Corporates have deleveraged in a significant manner. The entire corporate tax cut was used to deleverage. So balance sheet is in a much better position to absorb a slightly higher interest cost. If they are able to, if they are able to go and build capacity, they'll always take slightly higher on. I don't think it's a material issue. Also, we have to see the rates are the initial rate hikes, the initial 100 to 150 basis point of rate hikes anywhere in the world who have not hiked rates is only going to be normalization. You're normalizing post-COVID because you're no longer in a crisis to a level which was prevailing before COVID.
Okay.
So, it's part of that is going to be only normalizing, which means the corporates were already working at that interest rate and doing what they were doing pre-COVID, right? So some amount of increase in interest rate has to be discounted by that fact, and it should not have any material impact. If I look at India from a mortgage market perspective, like housing loans, agar housing loan abhi 6.5% mein mil raha hai, and then if it increases to 100%, 100 basis points, 7.5%, it's not going to materially change a buyer's decision. I think we'll see reasonably good demand. In the Western world, maybe it will be different because there the cost of mortgage, because mortgage rates were at 1-2%, and the choice of renting was almost similar, and that's why they were always taking the mortgage, buying the house, and living. That might change in the maybe in the US as mortgage rates move from say 2% to 4.5% to 5%. You might see that happening where more people will rent and less people will buy, and that will have an impact on building new buildings and new home sales. In India, I don't think it is material enough. Only at about 8.5-9% is when decision making on interest rates becomes a problem from a mortgage or auto loan or personal loan, that perspective. Right now we're at 6.5, lowest in multi-decade. Even if it goes to 7.5, I think we should be fine. I don't see a big issue. What you should think from a credit spread perspective is, what we have seen the US Fed doing is whenever credit spreads blow out, which means financial conditions tight. So you should look at the US high yield bond spread over the US treasuries. And if it goes above a particular level or particular historical level, is when they start thinking about, oh, are they tightening too much? Do they need to control their communication? Do they need to soften down? That's where they worry, because globally and especially in the US, the Fed central bank only impacts financial conditions in a big manner. They don't impact the economy as much, right? Initially, at least in the near term. In the near term is financial conditions, credit spreads, bond yields is what they can influence. So that's a thing to look for, saying that how long, as your question, right? How much will they go? So that will depend on how much financial conditions tighten and how the Fed reacts to it.
Okay. Very well pointers, and I'd like to highlight, as you mentioned, we've received the recent GDP numbers for US, and as you mentioned, US is in some bit of an upcycle with respect to growth, and that's why they easily, took the liberty to avoid the kind of contraction that we saw, or the lower numbers that we've seen in the GDP. But as you mentioned about capex, I was actually going to move on to the next question with respect to capex, and the fact that the whole corporate tax cut and deleveraging did bring in some fresh ability to go ahead with capex. The also question with respect to capex will be the kind of liquidity, and as you mentioned, liquidity is another tool for the central banks to manage the whole inflation and the financial conditions. So they are also talking about reducing the liquidity. So how would that impact the whole capex cycle for the corporates?
So when we talk about central banks removing liquidity, so in the Fed's parlance, it will be what we call quantitative tightening, which means it was opposite of quantitative easing, which was QE. So now you'll have QT, which means the central bank is either not reinvesting the government treasury bonds or the mortgage bonds that are maturing in the balance sheet, or actively selling bonds to be able to increase yields. That should have a significant impact on corporate spreads and equities, both, because when they do QE, people do not really understand it, but when they do QE, you always see government treasury bond yields rise, and that happens because when they do QE, people take on more risk. So they are moving from treasuries and selling treasuries and buying equities or buying corporate credit. Right? That's what QE does, because it is this Fed is kind of bailing you out or supporting the markets by their buying and adding liquidity, and you use that liquidity, or markets and investors use that liquidity to take on more risk. When they will do QT, that'll be the complete opposite, where people will, although in the sense that the first increase in yields will be in treasuries, because the Fed is actually not buying treasuries or selling treasuries, but the risk perception of the market will change. As lower and lower liquidity is available, the risk-taking ability also will kind of go down, and you will see an impact on credit spreads and equities. And that is a main factor. So rate hikes might be discounted, at least as you said, the first 150, 175 basis point rate hikes on the longer end of the bond market is kind of discounted in most cases. Maybe some further increases there. But what is not discounted is the risk impact of a quantitative tightening, which is what I said in the previous. If the credit spreads widen too much, as the Fed does QT, that's where the volatility will come. So this year will remain volatile in terms of what the Fed is thinking and communicating, and what the market is already pricing in terms of what the Fed is going to do. and you will have all kinds of volatility in that. The yield spreads will matter. Again, corporate capex, as I said before, is not as sensitive. It can absorb a 100, 200 basis point increase. Infrastructure, much more sensitive. Real estate, much more sensitive to rates. But corporate capex, if there is demand, and there is, if you look at corporate activity globally also and in India, there's been a significant consolidation, right? Look at India, 2016 demonetization, 2017 RERA and GST, 2018 financial credit crisis, ILFS, 2019 COVID. The small, medium sector or the weak balance sheets have kind of defaulted, gone out, not working, no longer that strong. And the market share has got consolidated with larger players. Right? So if there is a large player seeing large demand and there is not enough competition, they will be able to happily create capacity and serve that demand with a higher pricing power. So corporate capex should be okay. It's not as sensitive to interest rates.
Okay, so I get that corporate capex will not be that sensitive, but I really love the point wherein you also mentioned in the previous question that the initial 100-150 basis point would be the normalization of rates for the pre-COVID, and it may not be that influential or sensitive to the corporates or the players of the market, because it's normalizing to the pre-COVID levels and not changing the actual stance of it. Right. So that was one really good point. And so this brings me to the penultimate question, and it's going to be a very small one for you here, because we've been talking about rate hikes and QT as both the tools. Which one do you think is more apt in this kind of scenario? Because rate hikes, as we see, or rather inflation as we see, has been more on the supply constraints rather than a very significant increase in demand. So would rate hikes be an apt one, or QT has been or should be the more apt one because it's more on the supply side and not the demand side?
See, it depends on how far away you are from your inflation target, right? In the US, where the inflation target is 2, and right now they're at 7% inflation, averaging 4% inflation next year, they have to hike. They have no option. Plus, there it is not as much supply as much as is a demand, right? So there is a demand-led inflation. If you look at wage increases, hourly wages, if you track that chart, that's a significant increase in hourly wages, which means that labor supply is constrained, demand is higher, and wage pressures are going into inflation. Classic case of like demand inflation, right? So I don't think they will have a choice. They will have to do both rate hikes and quantitative tightening. India's case is slightly different, because fortunately India has food supply, right? A bulk of the staple food production, and that's a very large weight in the index, and also politically that's a very large component of social problems if food prices go up. India should be able to manage it better than other countries, especially staple. We might face some problem in pulses, we might face some problem in edible oils, but by and large we should be able to, because whatever supply side increase of inflation in food, India should kind of be immune. Even if fertilizer prices go up, the government can absorb it through subsidy. There is a cost to it. There's an interest cost to it also, but it's not as bad as others. Plus, India has a demand problem. I mean, we are still recovering, and as if you've seen the RBI report, I've not read it completely, but I've saw the snippets. They're saying that the actual GDP growth trend we will get back to only in 7-8 years. That long to get back to the pre-GDP, pre-COVID. Of course, at an assumption of 7.5% or something like that. So India is still demand constraint. This is not a 2009 to 2012 cycle where India had a runaway inflation, and that was largely driven by demand side, because we had a previous 5 years of very high growth. Land prices went up, gold prices went up, wages went up quite significantly, and growth was at 9% before Lehman and came to 9% 2 years after Lehman, after fiscal deficit. So we are not in that scenario. Unemployment is still reasonably large. There is surplus labor. So there is very little demand side inflation in most aspects. There are some aspects you will see demand side. So India, of course, from RBI's perspective, they have to be careful on how much they hike to be allowed the growth to still continue to happen, right? So in India, since again, there has to be normalization. So you'll have to, as I said, maybe the normalized repo rate will try to be not at 6.5, but maybe at 5.5, or between that level, and reduce the liquidity, but not as much, because in India, credit spreads and spreads in bond markets is more sensitive to liquidity conditions in the banking system as against rate hikes. Right? I would still expect RBI to keep liquidity in the system in surplus and hike rates, and see whether the supply side constraints go off, and then kind of the inflation normalizes. If it doesn't, if oil remains at $125 a barrel, if gas prices remain at about $8-9 a barrel, about MMBTU, then we have a problem. Then despite low growth, RBI will be forced to hike to fight it, and that will be a very serious challenge, because growth is, at the end, India is a growth market. Real GDP, as I said, has to be 6.5% at least, and nominal GDP has to at least be in the 11, 12, 13%. For our problems of poverty and infrastructure creation and income and wealth creation to improve, we need that growth. So it's going to be challenging, but let's see how the RBI reacts to it.
So that's a very good comparative that we have gotten over here, because, sir, as we have been reading about throughout media, they majorly focus on US as an economy, and there's not much on how the macro factors for our Indian nation has been doing. So this comparative actually brings out a lot of difference, because as you mentioned, the jobs, they are hitting, US are hitting their job or the employment targets. The job market is quite hot over there, whereas we are over here still having good unemployment rates.
Correct.
The rise of prices are in fact affecting India on the supply side. So there's a very good comparative, and I really love this question, and I'm happy that I asked you here. And we'll move to the final question for the day, sir. How do you look, as you mentioned, India is about growth. So how do you look India as an investment destination? What asset classes are you seeing performing over the years? And if there's anything else that we should be knowing, from the expert's point of view, what do you think? What's your take?
We feel that India in the medium to long term is in an upswing. So, of course, there are some short-term headwinds that we are seeing right now. Oil prices is one, inflation globally is one, and then how central banks react to it. But if I take a 2 to 3 or 4 year, 5 year approach, I think India is an upswing, and there are multiple reasons. One, very quickly, the government is finally spending, right? So till 2019, for some strange reason, government was not spending from a fiscal deficit perspective. But now they've realized that they have to get growth back. Growth is very, very important. So when government spends, the growth tends to be more diverse, right? More segments of the economy get benefited when the government spends, both central and state. As I said, corporate balance sheets are much better. So if there is demand in certain segments, certain industries, you will see corporate activity, because corporate balance sheets are much more deleveraged. They have cash on their balance sheet. Their ability to leverage is higher. And from the banking side, the ability to lend, risk appetite is much more. Bank balance sheets have cleaned up. Most private banks have raised capital. Government banks have been recapitalized. Enough liquidity, enough deposits. So even those two factors are agree. The other two important factors is residential real estate. We've seen a down cycle for almost 7-8 years. Yeah. And we may be seeing the first signs of an upcycle and it typically is a 7-8 year cycle. So we might be seeing a decade low housing loan rates, and also very less supply in certain segments of the market. And as demand picks up, as work from home has ensured that everybody wants an extra room, and that demand kind of feeds on both in tier 1 and tier 2 cities. Residential real estate tends to be the biggest economic multiplier for the economy, because when you buy a house, there's a transaction on land, then there's construction, then there's furnishing, then you take a loan, so mortgage gets created, then you buy consumer durables. So it's across the cycle, there is an impact on the economy, and it tends to be the largest multiplier for the economy. And if this residential real estate remains, it might not be in prices. So as a real estate buyer of residential, you might not make too much money, but from an activity perspective, if more people are buying houses and houses get created, it has an impact on the economy. And the other aspect of demand is IT workforce, right? We've seen a significant increase in workforce, and you've seen a significant increase in salary levels in the IT space. You saw that in the post Y2K scenario. And that was one of the big drivers for residential real estate then. And we are seeing that cycle now. And typically IT spenders are the higher income segments in the economy.
Sure.
They will buy a house. They will whatever extra income they've got, they'll go and buy a house, consumer durables, passenger vehicles, two-wheelers, a multiple set of it. And that has an income. So if I put all these together, the other part is export, right? Because global GDP is doing so much better, we've seen an increase in export. If I put all this together, but for the short-term headwinds of oil prices and food inflation, if you're able to overcome that, I think India is in a much better situation and should have a slightly better economic growth GDP output. In terms of investment, if I look at from a foreign investor perspective, although they've been sellers in the public equity markets, right? I mean, I think foreigners have sold almost $25 billion since October in the public equity markets. But how much low can they go? I mean, if I look at India's weight in the emerging market index, and India always gets a premium or over allocation. EM managers are always over allocated to India because of the quality of growth, the quality of companies, the quality of governance, the quality of earnings quality. That outperformance or overweight has actually gone down quite dramatically in the last 6-7 months. Of course, there's opportunities. Relatively, India is overvalued as compared to China, Brazil, Russia, all those countries. So maybe the money is moving, but there's a limit to how much they will underweight India, given the fact that if the headwinds are met and these tailwinds come true, the growth opportunity and returns could be a lot higher. And we've always believed as a house that when as foreigners look for India as a destination, they have to think about India as the next China. So whatever investments they made in China, they have not done well. Chinese public equities have not done well. Chinese private equity in education technology has actually not done well. Whereas in India, you will not get those kind of regulatory shocks. We will have our own cycles and political problems and this and that, but no major shocks like the regulatory shocks that China has seen. So if there is the global investor, which has whatever, if I look at all sovereign wealth funds, pension funds, university endowments, insurance companies, they have in total about $250 to $270 trillion of assets under management globally. And their investments in India across public equity, which is about $600 billion, fixed income is about $60 billion. If I add private equity, venture capital, infra, real estate, it won't be more than $1.5 trillion. So still, if I look at India's weight in the GDP, global GDP, we're about 3%. And India's weight in global GDP will rise. So in a country like India, which is going to have a higher share of global GDP, and investment and a portfolio allocation also has to be higher in as a percentage of their allocation, right? So they are right now less than 1% invested in India globally. Some will be a lot higher, like the sum of the Canadian pension funds may be much higher than 1%. But on a global total, it is not. So foreign investors have to think about India in that perspective. In the next 5, 10, 15, 20 years, if we have to increase our weight in India as per the global GDP or make it 2 to 3% of their portfolio, how do we do it? Who do we partner with? How do we invest in India? What kind of governance structures, politics, bureaucracy, equities, fixed income? And there's opportunity across, right? There's opportunity in infrastructure with InvITs. There's opportunity in real estate in residential now. There's opportunity in private equity. You've seen significant amount of money come into PEVC last year. Maybe we might not see that kind of, that was humongous what we got in 2021. But public equity markets are open, it's fairly liquid. So I think allocations will increase. You just have to time that allocation. But if your horizon is 20 years, it doesn't matter what is the valuation today. I mean, you will have to take your bets and prepare yourself. That's my message to whenever I talk to foreign investors. That's my message is, you don't give me the mandate. It's okay. You don't fund quantum, but think about how you want to invest in India and who do you choose as partners and what kind of internal teams you set up, and think about allocating 2-3% in India. And India has the markets to absorb that capital, right? Across all the assets that we have, public equity, private equity, fixed income, infrastructure, real estate. Look at the amount of money that India can absorb over the next 10 years. We should have that perspective. Short term, these kind of discussions, as you said, complexity and simplicity. The simple argument is you have to be in India and be in India over a long term, because India also needs long-term capital. So think about India in a very long-term perspective. Of course, valuations matter, governance matters, but these short-term movements here and there can be complex, and we'll have all the complex answers that I gave. But the basic thing is to keep it simple and make a long-term allocation.
So that's the perfect way to end. You see, I mean, there's one single line: "Be in India" for all the global investors from Mr. Arvind Chari, and that's quite an explanation, because definitely, I mean, the kind of government spending that we're seeing in infrastructure and other areas, or as you mentioned, the balance sheets for corporates, they are good and well deleveraged, and the reforms are in place. It's about time that we start doing better and more reforms, but India is certainly a destination for investment, and be in India, be in Indian markets. That was a very good conclusion as we got from Arvind sir. This was a very great session, sir. Very great session, and I thoroughly loved having a chat with you. The kind of insights, the kind of grip that you have on the markets is significantly good. And who's better to talk about global investments than Mr. Arvind Chari? So
I think you've been too
that's
flattering, but yeah, but thank you.
that's been really good,
With
and
good questions. I think we covered quite a bit.
yeah, that's quite good. So as of now, we'll take the closing session, and before going, I'd just like to mention one single bit, because it's quite relevant with the kind of geopolitical scenario that we are in, and it's from the British historian Mr. John Acton, wherein he says power tends to corrupt, and absolute power corrupts absolutely, and that's what we're seeing in the Russian-Ukraine setting, wherein the some of the great tragedies, rather, if we have to see in history, are or have validated how the power has corrupted the people at the top. So these are very temporary phases, and as sir mentioned, you have to be in India, because these will subside over a time. Let's look at a 5, 10, 20-year horizon, and we'll come back again with another series of who's who of finance. But there's nothing better start than this one. Thank you so much for joining us. It's been great. And thank you all for your kind listening. We'll catch up again. Thank you.